At this point, the market is shooting first and asking questions later. The big tech companies spending the money on those data centers want them delivered as fast as possible, and they're willing to pay premium prices to do so. The margins that those industrial and semiconductor companies are earning today exceed prior levels. So not only do they have very strong revenue growth, but they also have very high margins. And so that's been a supercharger for those businesses. Companies like Comfort Systems, ticker FIX, Modine Manufacturing, ticker MOD, Vertiv, VRT, you can name dozens of these. These businesses have transformed into much better versions of what they were 5 years ago. And so for those particular stocks, I think the question investors are debating is, how long will these good times last for? Because the minute Microsoft or Amazon or Google or Meta says, hey, we don't need 30% more data centers next year, we'll be fine with just the same amount of data centers that we built last year, those stocks are going to take a tumble.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're checking in with Jed Ellerbroek. Jed's a portfolio manager at Argent Capital, runs growth portfolios there, has some really fascinating points to make about the growth space. We talked about all things AI. We talked about how technology and what he calls technology plus makes up about 50% of our U.S. benchmark, the S&P 500. What that concentration in technology means, why having strong bets in technology still is justified based on valuations and based on the long-term secular growth story. Also, some of the risks he's looking for right about now around the world. So please enjoy this conversation with growth portfolio manager Jed Ellerbroek of Argent Capital. Hey, I'm super excited today to be sitting down with Jed Ellerbroek. Jed's a portfolio manager at Argent Capital, coming to us from St. Louis. Jed, I've heard really good things about you, and I appreciate you coming on the show today.
Hey, Dave. Thanks for having me. I'm excited to be here.
There's so much I feel like to talk about. We're coming through kind of a fire hose of earnings, particularly in the growth space. Just to get things started, because I'd love to talk a lot about, if we could, just some different growth names, maybe some other areas of the market, just sort of what we've learned here. But just to get us started, for people that aren't familiar with you and your approach, how would you just summarize your investment approach? What are the qualities of a company that you would need to see to put them in a portfolio you manage?
Yeah, thanks for that question. Argent Capital manages a handful of funds up and down the market cap spectrum. What unites all of those strategies is what we call our enduring business philosophy. So what we try to fill our portfolios with are companies that have a few characteristics. They have all of these. They have a durable competitive advantage that helps them fight off competitors. They have a management team that has a track record of allocating capital in shareholders' best interests. And that's a different formulation for each company, depending on their growth prospects, and other things, the strength of their balance sheet, et cetera. But we like to have alignment with the management team in that capital allocation area. And then finally, we look for companies that have secular growth opportunities. Not just growth opportunities this month or this quarter because, say, oil prices are high, but companies that have a kind of secular long-term reason why they are going to be able to grow faster than our GDP, for example. And then we like to package that with a reasonable valuation too, that gives our shareholders upside.
You said the V word, so we're going to come back to that because valuations are one of those things that I know are sort of hotly contested right about now, right? And whether valuations at current levels are maybe justified. So I'd love to get your take on some of that. So let's get right into it, though, if we could. We're kind of coming through, as I mentioned, an aggressive earnings calendar. A lot of the, 5 of the Magnificent 7 stocks reported last week. I feel like, to start off, I feel like we've gone through a couple of phases of the AI experience maybe recently. We had that phase 1, which was anything AI related was just on fire. Then we kind of transitioned to the AI consumers, right? Sort of like industrials, materials kind of companies doing well. Now we're in this next phase where I'm not sure what to call it, but we're starting to see some differentiation, right? So some companies that are kind of tied to the AI, narrative doing quite well, remarkably well, and others, sort of getting bid lower. How would you sort of describe this phase that we're in, and what are some of the components of that?
I think you laid out a pretty good construct there. We continue to see businesses exposed to data center construction lead the market. And of course, that includes the chip stocks, but it also includes those industrial businesses that you mentioned, that are providing products, providing services, installing HVAC equipment, etc., to construct these data centers. And the big tech companies spending the money on those data centers want them delivered as fast as possible, and they're willing to pay premium prices to do so. And so the margins that those industrial and semiconductor companies are earning today exceed prior levels. So not only do they have very strong revenue growth, but they also have very, very high margins relative to their history. And so that's been a supercharger for those businesses. Companies like Comfort Systems, ticker FIX, Modine Manufacturing, ticker MOD, Vertiv, VRT, you can name dozens of these. These businesses have transformed into much better versions of what they were 5 years ago. And so for those particular stocks, I think the question investors are debating is, how long will these good times last for? Because the minute Microsoft or Amazon or Google or Meta says, hey, we don't need 30% more data centers next year, we'll be fine with just the same amount of data centers that we built last year, those stocks are gonna take a tumble. If and when that happens. Now, that's not happening this year. It's not happening next year. The big tech companies told us last week during earnings season that not only is their CapEx spending going to go up, 60, 70, 80% in 2026 compared to 2025, but the early indications are that 2027 is going to be 40 or 50% bigger than what this 2026 is. So the demand for data centers remains extremely high, and those companies helping to build them, whether you're building the structure or you're putting the chips inside, demand is extremely strong. And then on the other side of the spectrum, you have businesses that the market has decided are basically AI losers. And that includes software companies, which have performed horribly, for the last year now. But that also, that it's spreading from software to other things. What I kind of describe as labor-heavy intermediary businesses, companies like the commercial real estate brokers, insurance brokers, wealth management custodians even. Schwab has taken a hit here over the last couple months on fears that AI is going to stop their growth or hurt their margins going forward. And at this point, the market is shooting first and asking questions later about those stocks. We haven't actually seen a whole lot of direct impact in the financials of software businesses thus far. They're still growing about as fast as they were a year ago. But investors aren't worried about next quarter. They're worried about 2 years from now and how good these Anthropic and OpenAI models are going to be 2 years from now, and whether they will, change the game in software development. And then also whether we're going to need, for example, commercial real estate brokers to grease the wheels of all these real estate transactions across the country, or whether technology is increasingly going to encroach on those activities.
I mean, that's the big challenge, right? I mean, there's this tipping point, I feel like, and I feel there's this fear underlying the market where we're wondering what company is going to now announce AI's completely destroyed their business model or something like that. To your point about sort of this growth story really is a secular growth story. And you're talking, what companies have told us is that this is, we're not at the end. We're sort of really continuing on in the years to come. It reminds me years ago, back when Apple was a phone company, right? Like an iPhone company, that was their main business. I remember looking at the math, like they can't sell an unlimited number of iPhones, right? At some point, everyone's got one. No one wants to upgrade. So it's like they had to kind of pivot. So what did you hear, or what have you seen, particularly from earnings, these recent earnings releases that give you the confidence that we're kind of nowhere near the finish line of that kind of iPhone challenge, right? I mean, that there's more to grow. And can you put some fears to bed, or maybe reignite them? Because I think one of the concerns is these companies spending $500, $600 billion a year in AI infrastructure, are the earnings matching those ridiculous amounts? So what have you heard to sort of give you confidence that that's a stable story as well?
Yeah. There are 4 companies that are funding most of this data center build out. Those 4 are Microsoft, Amazon, Meta, and Google. They're funding probably 75% of the data center construction in America today. Those companies in 2026, you add them up, consider them as one group. They are roughly spending basically all of their operating cash flow. They are funneling into building new data centers. 95% of their operating cash flows are going into building data centers. There's a little bit of share buyback going on. There's a little bit of dividend payment going on. And that's about it. So investors entered 2026 concerned that, well, gosh, they're already spending just about all of their cash flow building these data centers. You can't go higher than that. You can't go much higher than that. So how is this thing going to grow in 2027 and 28 and justify these really high valuations? And I think as we saw here in the first quarter and as guidance, for these companies indicates will continue here as we go through 2026, all of that data center CapEx spending is leading to upward revisions to revenue and profit and cash flow, which is going to fund that future growth. So a company like Amazon, AWS, which is about 60% of their profits today, AWS grew 28% this quarter. It grew 23% last quarter. It grew, I think, 19% the quarter before. So that's material acceleration in revenue growth. And those revenues are dropping to the bottom line. And revenues are going to grow faster than that 28% over the next 3 quarters. We're going to get up into the 30s and perhaps into the 40s as we get into 2027. And those incremental revenues dropping to the bottom line, funding additional data center construction. So that's kind of the fundamental strength or data item that gives us the conviction that data center CapEx is going to remain high, and that's going to keep, kind of powering the U.S. economy, which of course bleeds through into our stock market where we see really, really strong corporate earnings growth.
I would argue one of the larger takeaways from this earnings season, things are going pretty well is the way I would generally describe it, right? And we've seen a lot of, we're not seeing a lot of like downgrades in revisions. We're not seeing a lot of like, moments. So, as an advocate for my viewers, I always ask them like what kind of questions they'd like me to ask. And one of the themes that I picked up was just a fear that this amazing, clearly obvious secular growth story gets completely disrupted. And what would you look for as a warning sign that like, okay, this amazing narrative of huge investment in AI and the earnings just keep coming. Something's changed, something's different. We need to reevaluate these. Is it something that would be reflected in, lower revisions in some case? Would it be guidance? Would it be some sort of macro factor? Would it be interest rates? What would be the warning signs you would look for that would tell you, okay, this perfect thesis, now there's some, glitches here?
Yeah, a bunch of those things you mentioned are relevant factors. And I guess I would add two more to that list you made. The first one is the rental price for NVIDIA's GPUs. Right now, demand for that computing power exceeds the available supply. And as a result, we've seen the rental price for H100s, for example, and now the Blackwells too, rising rental prices as 2026 has progressed. That fundamental strength, that demand exceeding supply tells you data center CapEx remains the right decision for these companies. If that were to reverse, if we see those rental prices decline, that's a yellow flag for sure. Maybe that's even a red flag. And then I think the second thing that jumps out to me is I said 75% of the data center CapEx spending is coming from the big four. The 25% that's coming from other people, from the CoreWeaves and the Nebiuses of the world and the Fluidstacks, et cetera, that spending is very capital market dependent. That our capital spending, those dollars are being, borrowed and equity is being issued. And right now, capital markets are friendly and welcoming, but we know capital markets are extremely volatile, and we can't take that friendliness as a given, indefinitely. And so if a war in the Middle East causes oil prices to go to 200, not 100, we're looking at a different GDP growth scenario globally and probably different looking capital markets too. And so I think that like capital market access and rates is important for the spending group outside the big four.
Really well said, and I appreciate you highlighting some of those points, Jed. I'd love to come back to the macro environment for sure, just to to get some sense of how you're trying to navigate through a challenging period on the macro side. But if I could go back, you listed out the 4 names, which you said sort of 75% of the AI data center investment: Microsoft, Meta, Amazon, and Alphabet. As a trained technical analyst, I can't help but notice 2 of those stocks are looking pretty good right about now, and 2 of them definitely not, right? You have 2, Amazon and Alphabet, just remarkably strong, outperforming, strong performance characteristics. Microsoft and Meta look completely different. I mean, they look like investors have really cooled off. Is that something that you think the market is in some ways getting wrong, that they're not focusing on the right things? Or are you seeing sort of challenges in those stories with those companies in particular that make you feel like the lower prices here might be justified?
Yeah, we especially like Microsoft today. I think that the valuation is appealing. The stock has done really poorly over the last year. I think it's done poorly for a couple reasons. First of all, of course, a lot of Microsoft's revenue comes from the sale of software to enterprises. And investors are scared to death of software exposure today because of that AI disruption risk. Microsoft reported earnings, though, last week, and their software business is growing at a double-digit pace, and it's not cooling off. That's a good thing. Investors aren't going to be, satiated by one quarter, but I think if Microsoft keeps stacking up the quarters and showing this double-digit revenue growth, coming out with new software products that embed AI, tools in them, and are able to cross-sell that to customers, I think investors will be convinced eventually. The other thing investors have been concerned about is their Azure cloud computing unit has been growing really fast for a long time, but Microsoft's management team has made the decision, hey, we don't have enough GPUs to do all the things we want to do. And so we're going to allocate a bunch of them to Azure and our customers, but we're also going to retain some internally for our own product development, our software development. And every GPU they put toward their internal software development is a GPU that can't be used to generate revenue immediately in their cloud computing unit. And so management's decided we're going to do a little bit more of our own product development. That's not going to pay off this quarter or this year even, but down the line, that's going to be a net benefit for our shareholders. And we're focused on the long term. So that kind of internal allocation decision has soured investors on near-term results and slowed growth a little bit. That's a headwind today. I think a year from now, that headwind can flip to a tailwind. And so I think Microsoft is an outstanding company. I think it's being managed really well by some longtime experienced executives. And I think they have an extremely strong competitive position.
Yeah, I love that answer, Jen. As you're talking, it reminds me a lot of some positive memories of my time working at Fidelity. I remember when the market would be down 20% and the portfolio managers generally would be a very happy group, the growth managers. And they would be like, I just got a Bed Bath & Beyond 20% off coupon on amazing companies, great opportunity. So they were all excited. So I appreciate, and I think that proper long-term perspective is really important there. I appreciate you highlighting that. So you've mentioned the word valuations a couple of times. So I'd love to just ask, I interview a number of people, and I've heard some make the case that valuations generally, particularly in the growth space, are so unreasonably high. The prices have gone up a ton. This is unrealistic. Look back at the history. We're at the upper end. But then I've also heard people saying we are undervaluing the growth potential in these companies in a growth-led bull market. Valuations are less meaningful. How would you describe sort of valuations? How does that fit into your decision making? And what's your take on applying valuations to the current market here?
Yeah, that's a wonderful question. So our process, like I tried to describe at the beginning, we try to identify these enduring businesses, and then after we've settled on that question, we consider valuation. So valuation is not the first thing we look at. It's actually toward the tail end. That's how we kind of construct the portfolio and make those final cuts. We try to separate that in our minds from that enduring business assessment. The valuations are higher today, than they've historically been. But also, corporate earnings are stronger today than they've been. Our economy is dynamic and resilient and growing rapidly, and it's very impressive. And I think the quality of businesses, if you look at just the universe of U.S. stocks, I think the quality, the profitability, the return on capital of that big thing is improving over time as our economy shifts more toward technology and data as the basis for competition and competitive advantage, and less is Walgreens on the best street corner in town versus CVS, And so if you look at the S&P 500 today, it's a lot more tech and a lot less financials and materials and energy than it used to be. And tech gets a much higher valuation than energy and financials and materials for pretty darn good reasons, both profitability and growth prospects. So I think any discussion about long-term valuations needs to recognize that fundamental change in our universe of stocks here in America. When I factor that onto my thoughts, I think valuations today are reasonable. I wouldn't argue they're low. I also wouldn't argue that they're prohibitive. And so that's kind of my big universal lens.
Really good points in there. And you'd alluded to, our benchmarks in the U.S., obviously very growth oriented compared to a lot of non-U.S. benchmarks for sure. About a third of the S&P is technology alone. And I think for many investors, that's a scary prospect that so much of the benchmark is technology. So just to have a benchmark weight, it feels like you have to own a lot of tech. It feels like you're super overweight. How do you think about that concentration in the benchmark when you're constructing a portfolio, right? How do you think of that, sector allocation? And, should we be okay, allocating a third of our portfolio in the equity space to technology? Or how do you think about overweight or underweighting that, obviously huge, elephant in the room sector-wise?
You're right. The S&P, in the S&P 500, technology is, I'm looking right now, it's 36% of that S&P 500. That's a humongous number. No sector's ever been that high as far as I'm aware. We try to take it a layer deeper than that though. And we call this concept Tech Plus. So yes, the technology sector is 36% of the benchmark. Communication services, which includes Meta and Google, is another, that piece of the communication services sector, which was spun out of tech a handful of years ago, is another 10%. That gets us to 46%. Then you take Tesla and Amazon, which are both listed in consumer discretionary, but we all know these are tech businesses. That gets you another, nearly 6 or 7%. So you add all that up, you get 51.5%. That's what I think the Tech Plus weight is in the S&P 500. That's an enormous number. And obviously, investors want a diversified portfolio. They want a balanced portfolio. They also want to earn a good return and keep up with the benchmarks. And so, you've got a couple competing interests there, and investors today have to balance that in a way they didn't have to 10, 15 years ago. And so I think it presents interesting dilemmas for capital allocation, at the portfolio level, and for financial advisors, of course. An additional complication that I think you can layer on top of that is that technology as an industry lends itself to winner take most or winner take all economics. Google has 90% share of search. Bing has 7%. I don't know what has the remaining 3%, but like 100% of that search industry's profits are generated by Google and a tiny portion by the number 2 player. The benefits of our economy growing and technology improving accrue disproportionately to number 1 and number 2 in an industry. A really good way to lose money is to buy cheap tech stocks that are the number 3 or number 4 players in their industry. Like all of us who have been investing for decades can rattle off a bunch of those companies, a bunch of stocks that we thought were cheap tech stocks that are value traps in effect. So if you want to invest successfully and grow your capital, you probably overweight the leading tech companies, the Googles of the world. And then you go and look and you're like, oh man, Google's 6% of the benchmark. If I want to overweight Google, I need to be up at 8 or 9%. And also if I want to overweight Amazon, that's another 7 or 8%. And then, pretty quickly you find yourself owning a portfolio with only tech stocks. And so these are really hard capital allocation decisions. Choosing not to own those big weights in the benchmark, that is an important decision. Not owning a Tesla because I think stocks that traded 100 times earnings is silly. I don't want to own stocks that traded 100 times earnings. That's my natural bias and inclination. But gosh, Tesla's been a pretty darn good performing stock over the last 10 or 15 years, and it's cost a lot of money for our investors, opportunity cost in not owning it. So I'm just highlighting a few of the really difficult decisions that come with large cap investing in the United States today. And I'm afraid these decisions are getting harder as we go, as AI kind of is adapted by businesses and consumers. This problem's getting harder, not easier.
100%, right? We've seen this like further and further concentration in the benchmark. We're seeing further domination with technology. And it's so funny, to your point. I think, the powers that be at the S&P start breaking out names and bucketing them in different sectors. In the end, half the benchmark, if not more, is technology or like technology adjacent. I also appreciate you boldly refusing to call the company Alphabet. I'm with you. We'll call it Google. I'm okay with you, Jed. We're on the same page here. It's also Facebook. Okay. We're not changing. So we've gotten this far with only briefly mentioning a major conflict in the Middle East. And I know for a lot of investors, they are, and you can see the market reacting very quickly to headlines, right? I mean, things are great, market pops. There's, the ceasefire is questioned. All of a sudden the market goes down. We're seeing very quick, sudden reactions. But a lot of your discussion has been more secular growth, more longer term. So my question is, how do you sort of think about the risks based on the events in the Middle East and sort of the ripple effects? Because a lot of the debate has been, there are things that are happening now that won't be felt for 6 to 12 months, and it's going to be really bad. So let's get out while the getting's good. How do you manage the risks of some dangerous, development there versus these long-term secular stories that seem relatively stable and relatively impervious to what we've seen so far?
Yeah, there are a few sectors, energy is one of them, utilities is another, where these sectors historically, and I'm talking the last maybe 20, 25 years, these sectors tend to underperform more often than not. But when they outperform, they do so by a lot. And so from like a portfolio construction risk standpoint, we've made the decision to own these sectors, have some investment in these sectors, but not overweight them. And so, to try to kind of balance those two competing thoughts in our head. So we've owned ExxonMobil, an energy company, in our strategies for the last handful of years. Obviously, that stock has done fairly well with this Iran war. We also own a company named Murphy USA, which is a smaller business, ticker MUSA. It's a convenience store business. And most of their profits come from the sale of fuel. And we have an emerging inventory problem in the world with the Strait of Hormuz being closed. We talked about a lot of our learnings from last week, and a lot of that was tech-oriented. But one of the non-tech-oriented learnings last week for me was the fact that almost all the energy executives of the big energy companies in the United States said, our inventories of oil are running down. And every day the strait is closed, those inventories narrow a bit. And if we hit zero, and of course we'll do that on a geographic buy oil type basis, it won't be all at once, but we're about a month away from inventories getting really, really low. And that's going to cause major problems, and oil prices are going to be a lot higher than they are now if it gets to that point. And so there's real concern about that. There's a real fear that oil prices are going a lot higher globally. And all these tankers that can't get through the strait, a lot of them are coming to the United States to gather oil and then take it abroad and sell it to Asia where the prices are high. So our oil markets in the US are getting really tight. And a company like Murphy USA, which has a fuel distribution business, has seen their profits just skyrocket since the strait closed in February. So I think, and that's, I didn't predict the war. I'm not claiming credit for that in any way. I guess what I'm highlighting is balance, diversification, exposure to a bunch of different investment themes is important for a broadly diversified, long-term oriented portfolio. And energy stocks are a part of that, a small part of that, but nonetheless a part of it. And I think utilities are too. And utilities are like before our eyes turning into growth vehicles. These were stocks for retired people who want dividends 10 years ago. Today, these are growth companies.
Yeah. No, I appreciate so much what you put there. And again, thumbs up on the chart for Murphy USA. I mean, it's one of the better, upside rotations we've seen. So A+ on that one for sure. And I appreciate you highlighting some of these other areas of the market showing strength. One final question, Jed, just to finish off here. Coming through earnings season, and I apologize, I made this so much about AI and tech, but you were sharing some really good thoughts, and I wanted to go as many places as we could. Anything else stand out? I mean, any other ideas coming out of earnings that surprise you to the upside, or that you think this is one of those areas outside of that 50% tech overweight we're all nervous about? What other areas where anything that stands out that we should be thinking about?
Yeah, I would point people to aerospace and defense. Those stocks have not done very well in the last year, which to me is surprising. All the talk about a 50% increase in the U.S. defense budget, for example, you'd think the Lockheed Martins of the world, the Northrop Grummans of the world those stocks would be sky high, but that's actually not true. So I think those stocks are interesting values today. And then on the other side is aerospace, traditional commercial aerospace. And those stocks have pulled back as well. And the reason they've pulled back is because of the Iran war fears. Airlines are cutting their travel itineraries, by 2, 3, 4%. And so that means less commercial aftermarket activity for GE. I think that we are undersupplied in terms of planes today. Boeing has a huge backlog. Boeing hasn't been able to deliver on their backlog as well as they would have liked. The same is true for Airbus. And so we're running planes longer and harder, which means more aftermarket activity for the GEs of the world and the TransDynes of the world. Mm-hmm. And those stocks have pulled back, but I think they have really good kind of fundamental long-term growth outlooks. So I would point you to both aerospace and defense companies today as an interesting value after underperforming here recently on things that I think are more short-term oriented.
Really appreciate you going there. And again, those are some of the better performers that we saw like in 2025, right? But a lot of those names, the aerospace names, the defense names, Raytheon's another one that comes to mind, all kind of pulling back here. Was that an Iowa Hawkeye Cup that I saw you hit from earlier? Is that true?
I'm always trying to promote my Iowa Hawkeyes. So yes, I'm just chugging water over here.
I'm a Buckeye, so I hope we can still be friends after the interview.
We can't. I think we play this year.
I've been to Iowa City a number of times for football. I mean, some of the genuinely nicest, most friendly fans I've ever met. So I'll be happy to go back and maybe our paths will cross down the road. But for now, Jed, I will say thank you for coming on the show. Great insights. I appreciate you sharing your expertise. I hope we can continue the conversation again.
Absolutely. Thanks for having me.
Great interview, and I really appreciate Jed joining us from Argent Capital today, sharing some observations on market conditions. He described their investment process at Argent Capital, and I love that. It's something to think about as an individual investor if you're considering, stock picking in the growth space. Durable competitive edge was one thing. A management team, really with the shareholder values and shareholders in mind. And then the third is secular growth, and then valuations as an overlay. And I thought that was helpful to see where valuations fit in the decision-making process, right? You don't start with valuations. I think that's a mistake a lot of investors make right about now. They start off looking at valuations, start painting this whole story based on the valuations. His point is, look for good companies with good management, with good growth prospects. Then we'll talk about valuations second. I think that's certainly a very appropriate way to think about valuations within the context of an overall investment process. Really helped him differentiating within the AI space, right? Those big four, the reported earnings, why Microsoft and Meta have been struggling relative to Amazon and Google, not Alphabet. But that whole idea of the AI data centers, why that's such a big thing, why the investments are being justified by investors and the earnings that are supporting those stocks to go further. Outside of the tech plus 50% benchmark discussion, which I thought was really interesting, really appreciated him highlighting some other areas of market opportunity, particularly coming through earnings season. And as a review, we talked about utilities as a growth story. Can't disagree. We've seen a lot of strength in utilities, which feel much less like a low volatility, sleepy sector and more like a growth opportunity driven again by the broader AI theme. Looking at aerospace names, defense names, and I thought he had some really good points to make about that. Hopefully that also, if you were in that camp, I sort of spoke on behalf of some of my viewers that have been weighing in about, concerns about Iran and because of the conflict, here's why we don't want to be buying stocks here and those sorts of arguments. And I appreciate and understand what's driving that discussion. Hopefully Jed's comments sort of alleviated your anxiety a little bit about that impact, because again, for him, it's more about the long term, right? It's more about the secular growth opportunities, which means, events like this could be a short-term impact and not a long-term impact. However, toward the end, I asked him some of the risks he was looking for, and I really appreciated him outlining some of those specific items to look for in terms of NVIDIA and also some broad market inputs like interest rates. Great interview there, and thanks again, Jed Ellerbroek, for joining us from Argent Capital. It's always a pleasure. The conversation with Jed reminds me a lot of conversations I enjoyed working for a large money manager and just being able to talk about companies and narratives and stocks and how their decision-making process works. And I hope you got just a taste of that with our interview today. By the way, we highlighted, as we were talking, a number of the charts that actually look pretty constructive. Things like, Alphabet and Amazon with strong charts. Murphy USA, MUSA was a name he highlighted with a very much an improving technical structure. If you want to up your game on how to think about the technical component, the technical analysis side that can help complement a well-defined fundamental process, as Jed Ellerbroek described, our Market Misbehavior Premium memberships may be a great opportunity for you to upgrade your decision-making in your portfolio in 2026. 3 great benefits to our premium membership. First off, we'll teach you all about technical analysis and behavioral finance through our virtual courses. Number 2, we will keep you informed and updated and educated using our member-only reports like our monthly chart review and our weekly flight plan. Finally, you'll have full and immediate access to our member community, a supportive group of like-minded investors where you can ask questions all day long and gain guidance and mentorship from me and help from your other like-minded investors. All of that can be yours today if you go to marketmisbehavior.com/premium, which has all the info on our premium memberships. That'll do it for today. Thanks so much for joining me here on the Market Misbehavior podcast. We'll be back again soon with another great discussion. In the meantime, remember, it's always a good time to own good charts. Take care, folks.